good evening, everyone. Hopefully, I am audible.
Good evening, ma'am.
Am I properly audible? Okay.
You are audible, ma.
Okay. Thank you so much. So, today we will be starting with block 4, and it is financial statement analysis. So, before we start this, let me see how many of you have joined. 22. We will start. So, I hope you have started giving your attendance in the chat box. So, we are starting with the financial statement analysis, and this is block 4. And if you go with this, you see we have to go with, just coming back to this. This is block 4, financial statement analysis. And in this financial statement analysis, we have unit 13, that is understanding annual report. Then we will come to next. This is something more practical type, theoretical type rather than practical. Practical part is there, but it is compared to other blocks. Here the practical is very less. It is more of understanding. So that is what about understanding your annual report. Then we will come to the chapter 13 or unit 13. It talks about ratio analysis. Ratio analysis is done to understand or to compare two datas. First, we'll understand what is financial analysis, financial statement analysis, and once we know what is financial statement analysis, we'll come to the ratios. Ratios are used for taking strategic management decisions by the firms. On the basis of ratios only, they try to compare the data of two consecutive periods, and then they come to a conclusion of taking more decisions regarding the changes or expansion of the country, of the company. After understanding the ratios, we will have, this is the keywords, and the last chapter, it is related to comparative, common size, and trend statement. Again, when we talk about comparative, common size, and trend statement, it is again related to your more theoretical part. So this is what we are going to have. We have three chapters. So let's start with the first one. The first one is understanding the annual report. So what we are going to actually focus on, we want to first navigate the annual reports, means we want to deeply study the annual reports. Then what are the contents in the annual reports? Now I think we all know what is annual report. We all are at least working, or we have studied previously also. Do you know what is annual report? Say yes or no.
No,
Okay.
no.
Then coming to the next, once we understand what is annual report, the contents of annual report, then we will take the qualitative and quantitative aspects of the company. That what are the things that the company includes in that annual report, what is the qualitative aspect, and what are the quantitative, that means how the annual report is expressed in terms of numbers. And the last one is to understand the financial statements. Financial statements, it is a group of statements and accounts. Whatever accounting work we do throughout the year, they are being summed up into two or three form of statements. Those statements are known as financial statements. So it is the contents of annual report, the difference between the public and private company, how the annual report of a government company looks, right? What is green annual report? Nowadays, we don't go with 100 pages of publishing the annual report. We want to save the pages. So it's green annual report. And then, of course, the keywords and the self assessment. So now, if we start with understanding the annual report, the first thing is that annual report is nothing but it is a document which contains some important areas. Now, when we need to find the financial position of a business, whether the company is in profit, loss, what is the position of its assets, liabilities, what is the expenditure made throughout the year, what is the income received throughout the year, this all are summed up, and then they are presented in the form of annual report. So mostly annual report is prepared yearly. So it contains all the information about the business of the firm. I told you it reveals the financial position and performance of the company. So once we read the annual report, we can understand the importance and the qualitative aspects that are included in the annual report. So there are various stakeholders. There are various people, like they have mentioned, investors, analysts, researchers, suppliers, customers, employees. In they all use the published annual report for making decision regarding, if you say investors, for investment, analyst for research, suppliers to know whether they are going to get back their money or not, the credit system of the company, the customers, they want to know the customer supplier relationship, how effective it is. So these are the areas where all the stakeholders wants to have a thorough knowledge, thorough information related to the annual report. So this we are going to see how the contents help different stakeholders in the firm, to help them to navigate them throughout their journey for knowing the informations related to the above areas. So the first important thing is that annual report is a document that is publicly traded or listed companies must have. Now, when we talk about that annual report is a document which the public companies must have. So here the first thing that I want to make you clear is that what is a public company? A public company is a company which is listed in the stock exchange. So when the company is listed in the stock exchange and it brings out its shares in the market, those companies are compulsorily, it is a mandate for such companies to provide the shareholders and the stakeholders a complete published data of their function. So, the company's operation and financial performance position are being published in a detailed manner with the graphs, tables, and informations. So now if we start with the contents of the annual report, you can see a figure which we will display now. There, when we talk about the annual report, there are certain areas which are known as non-audited information, then financial statement, and then notes to the accounts and accounting policies. So the annual report contains four areas. One is which is not audited information, that is general information provided by the company, information regarding the company. The second is the statements, which is audited one. The CA has verified the transactions. Then there is certain amount which is displayed in the financial statement. The summary of those statement is notes to the accounts. Suppose you have written that we have a debtors of 1 lakh. So debt 1 lakh, it is only debtors. Who are your debtors? Or who are your customers? Who are your suppliers? You have taken a loan from various organizations. So what are those financial organizations? This all summary is in the form of notes to the accounts. And the last one is accounting policies, revealing that what are the policies which the company follows. So this is the contents of an annual report that you need to understand. Just read them once before we start. You can say it is on non-audited information, the first part, where you can have the information about the company, where you can have information about the directors of the company, where you can have information about the place of business, their areas of business. This all are under non-audited information. Next, we have financial statements. Financial statements, I already told, it is the quantitative aspect, quantitative information about the company. Next, we have notes to the accounts. Notes to the accounts, what are included in the financial statement, their detailed information, their transaction, their summary is in the form of notes to the accounts. These notes to the accounts are also known as annexures, which are attached along with the financial statement. And the last one, it is the accounting policies which the firm has followed. Now, when we talk about non-audited information, it can be narrative items, it can be non-narrative items. Financial statement, it consists of cash, balance sheet, profit and loss account, and cash flow statement. So now if we start non-audited information, I told you under non-audited information we have narrative and non-narrative. Narrative items means the chairman's statement, the director's report, their corporate governance policy, the auditor's report in detail. Then what are the director's responsibilities? Nowadays it is very much common, the sustainability report, the management's discussion and analysis. Coming to the next, this is all the contents of the narrative report. It can be the chairman's statement. So just see this because it is not possible. In every organization, you will find this chairman's statement. Chairman addresses the shareholders. Whenever you open any of the company's audited report, you will find the first page with the chairman. Chairman is the owner. His statement addressing to the shareholders and all the stakeholders. Am I clear here? Okay. Then we have director's report. Other than the chairman's report, we have a director's report, which is the supplement to the information given by or provided by the chairman. Again, whether it is a report provided by the chairman, provided by the directors, they are full of appreciation about the company's activities. Throughout the year, what the company has done, what are its achievements, what are the areas where they are thinking of expansion, diversification, and so on. This is a report of a company, Hindustan Unilever Limited, and here it is the description. I already told you about the activities of the company, what the company wants to do in future, about if they have any expansion and diversification plan. All the information related to the value of the assets, what the dividend they are going to propose in the year, have they purchased any important asset, the number of people working in the organization, what is the interest lying with the directors, what donations they have made during the year, what are the corporate social responsibilities they have offered. This is all related, and these all points are included in their report. The third part of the report contains about the operating and financial review. After the directors and chairman's appreciation, operating and financial review means that this is the statement made in the annual report that explains the financial performance of the company. Financial performance means the explanation of their profit and loss, their income and expenditure, and so on. They also try to give a satisfactory review on the results which they have obtained throughout the year. And on the basis of that results, they are going to declare the profit and the dividends thereon. They also give you a detailed explanation on the capital structure of the company. What is the share of their stock, yes, securities issued, and how much loan the company has taken from the market. Corporate governance, I already told you how effectively, efficiently, to what extent they have offered their corporate social responsibility, because CSR is a something which they have to comply with according to the Companies Act. So, what are the best practices the company offers as a good corporate governance? What the company focuses on? They have to be very transparent related to all the activities. There should not be any game of hide and seek. Okay, what is the value? What is the goodwill of the company? What is the credit rating if the company is in a financial, if the company is into financial transactions? What they are aiming in increasing the overall performance of the company? How they are going to lower the cost of capital so that in turn they can increase the return on investment, how they are going to access the capital market, and then increase the competitive edge among the competitors. Next is the auditor's report. Auditor's report is the report which the company's auditors, that is the certified accountants, chartered accountants or financial experts, they, after auditing the whole year's transaction, then they publish the company's annual report. Without the signature of the auditor, no company can publish its annual report, and the annual report doesn't has any validity if it is not accompanied with the auditor's signature and seal. The report of the auditor is very important because the auditor will declare in the report about the company's all transaction. The auditor is appointed by though it is appointed by the shareholders of the company to audit the accounts, but at the same time, it is the moral responsibility of the auditor to publish all the reports in full honesty. And the auditor's report is given to each and every member of the company. Sustainability report. Sustainability report includes the economic, environmental, and social impact caused by the company's everyday activities. Is it going to hamper? It is going to provide any loss to the environment? How it is catering to the social needs of the society? These all things are communicated through the sustainability report. There are different laws, there are different regulatory authorities. So, the regulatory are the company going to follow all the regulations? Like we have a central bank, we have a security exchange board, we have insurance regulatory authorities. So, each and every authority has given certain guidelines. So, the companies falling under those areas, have they complied with all the legal formalities or not? This is all narrative, that is pure theoretical. The next part, which talks about non-narrative items in your annual report, it is the financial highlights, which is required for the shareholders' information. It talks about what is your income from the operations throughout the year, what is your earnings before income tax, or before paying interest, tax, depreciation, and amortization. It also talks about what is the rate of return on equity that you are paying to the shareholders, and once the tax is paid, then how much profit is left with the shareholders, because with the remaining profit only the dividends will be discussed. Next, it talks about the highlights of the year. When we talk about the highlights of the year, it talks about your performance during that particular year. It can be the launching of the product, it can be opening new showrooms, it can be related to the mergers, it can be related to acquisitions, it can be related to new brands, and so on. Then we have the second category, it is the financial statements. What the financial statement talks about? They have a three category: balance sheet, profit and loss account, and cash flow statement. These are the most three important statements, that is the content of your annual report. So the three important statements are: what happened, Simeon? You want to say something? You have raised your hand. Simeon Calago? Okay. So I was talking about balance sheet, profit and loss account, and cash flow statement. Okay, no issue, Simeon. I understood. So when we talk about balance sheet is a statement which is prepared on a particular date, that is preferably on the last day of your financial year. If your financial year is April to March, then the balance sheet is prepared on 31st of March. So the balance sheet, it gives you the position of your assets and liabilities in a particular year at a given time. So the balance sheet, it is the bird's eye to know about the position of a company. It indicates what the company has and what the company has to pay. The excess of assets over liabilities, if assets are more, which is preferred, compared to the liabilities, it is known as, the balance is known as the shareholders fund or owner's equity. And if your liabilities are more, then of course it is a loss. The next part of it is profit and loss account. The profit and loss account gives you the information related to the trading activities, revenue from sales, the expenditures incurred throughout the year in the operating activities, in the functioning of the business, what is the tax paid, what is your earnings after payment of tax, what is retained earnings, from the profit how much you want to give dividend and how much amount you want to keep it for the recycle of the profit. So this all information is available in your profit and loss account. The third part is your cash flow statement, which we have done in the first block also. Cash flow statement gives you a clear picture about the position of your cash on a particular day. Position of your cash means after taking into account all the cash incomes, that is inflow, minus all the outflow of cash. It may be regarding some purchase of asset, it may be regarding the payment made to the financiers, it may be expenditures made towards the functioning of the operation of the business. So all this together are taken into account, and then the cash flow statement reveals the actual cash position in a particular point. What is notes to the accounts? The summary. If we say depreciation has been charged, now depreciation, what is the rate of depreciation? How much depreciation? Because the rate of depreciation is different for each type of asset. For machinery, you will charge different depreciation rate. For vehicles, you may charge different depreciation rate. So what is the depreciation rate applied into different forms of asset? Next, we talk about the position of inventories. We say inventories lying at the end is about, closing stock is 10,000 rupees. So in that closing stock, it is not all your inventories. Few may be raw materials, others may be finished goods, others may be semi-finished goods, others may be which are already in the process, work in progress. So the breakup of all the inventories is taken into notes. Details of assets and share capital. What is the combination of assets? Who are the providers of finance to the company? What is the director's earning? And what is earning per share, EPS? This all information is included in the notes. The next part of this is accounting policies. Now, accounting policies, the companies has to describe mandatorily that compulsorily the policies that it has used for preparing the financial statements. So the companies have a choice of accounting policies related to the management of foreign currencies, related to the goodwill, related to pension, sales, and stock. This all differ from company to company. There is no compulsory, there is no mandate that the company should hold a stock of 20%. For some companies, they can hold a stock of 20%. Other companies can hold a stock up to 50% also. So this varies from company to company, and that is why there is no compulsion in that. And what is observed by each company, that has to be furnished in the accounting policies. Now, if we come to the next one, these are the contents of your annual report. Now, what is the difference between a public company and a private company annual report? See, public company is a company which is owned by the government, and private company is a company where we do not come up with the shares. So, private companies can prepare their annual reports as per the Companies Act. But your countries may have different Companies Act. Here in India, we follow the Companies Act 2013. So this Companies Act is different for every company. So one is public company, the company which is limited by shares, the companies which can issue shares from the market, they are public company. Private company, the companies which are not allowed to issue shares from the market. And the third form is the companies which are run, owned, and managed by the government. So each type of company has to prepare their financial statements according to the procedure which is laid down in the Companies Act. Now the next part is your green annual report. I told you previously it was very important to have annual report published in 100, 200 pages. But now with the concept of sustainability, sustainable development, environmental sustainability, we do insist on green annual report. So when we talk about green annual report, it means that we don't bring the report in the printing form just to save the energy, trees, and water and reduce the greenhouse gases. So we can have the annual reports printed using eco-friendly sewings in comparison with traditional petroleum-based ink. So it has to be printed with eco-friendly inks. An eco-audit audit statement is also placed in the final document, where we do not give much preference on the printed hard copy of the report. Now the last one is the summary, which we all have explained. Here the word AR is used everywhere. AR here represents annual report. So these are the keywords. The first part, understanding annual report, is done. Just go through the keywords. Just read them. I hope you have understood. Just read the first one. What is an annual report? It is the detailed presentation, description, information about all the functions of the organization. The second one is auditor. Who is an auditor? An authorized, qualified person who complies with the accounting laws, procedures, tax laws, and then verifies the accuracy of the financial transactions. Now, who are the board of directors? What is corporate governance? And what is ESG? ESG is environmental, social, and governance. These three are used in measuring the sustainability and the impact of the company on the society when the company invests in a business. So, board of directors, they are the elected group of shareholders. Corporate governance, and environmental, social, and governance. Then we have the last one. It is Green Annual Report. Now you can see this. This is a very important part. If you want to really understand what is an annual report, they are saying you can download the annual report of any company. Dabur India Limited 1919, it is a old content, so it's given. You can download, you can view the annual report, you can type it, the annual report of a such as such company. There are so many important companies which may be there in your country or in your state. You just see them, download it, and try to answer these questions. Who is the chairman of the company? Who are the internal auditors of the company? Do they have a corporate office located at their place? How much they earn as a from the domestic market? How much they earn from the international market? Is the company involved into social responsibility activities? So these are few questions. You can yourself go with the answers. How much tax they have paid, and so on. There are so many questions. You see, these are all self-assessment questions. 40 questions are there. You can easily find them. Now coming to the next one, ratio analysis. I hope till now it's clear. Do you have any doubt?
Yes, madam, it's clear.
Okay. Other than Aliyu, anyone has doubt? He says it's clear because
Mama.
it, it was total theory. Yes, please. Murjana too. What is your name? How to pronounce?
I think she has left. It's Murjana too.
Murjana too. Okay.
Yeah.
Do you have a doubt, Murjana too?
Doctor, I have a question.
Yeah.
Is annual accounts and annual report the same thing? Mean the same thing?
Yes. No, they are not the same. Annual account is your financial statement. Okay. Balance sheet,
Okay.
profit and loss account. An annual
Okay.
report, it consists of, other than the quantitative aspect, the qualitative aspect also, like the chairman's report, director's report, the accounting policies, notes, etc. And when it is accounting, it is only quantitative aspect.
All right. All right, ma. Thank you.
Okay. Okay, so let's start with the next unit. It talks about ratio analysis. So ratio is a comparison. Actually, ratio means what is its percentage. If we compare two data, the percentage of one with another. So when we go with the accounting ratios, we will start with type of ratios. Under type of ratios, we will study profitability ratios, liquidity ratios, leverage ratios, coverage ratios, efficiency or activity ratios, and investment ratios. So these are the various types of ratios that we are going to study. We will not go with the introduction part. It is simple. The data for calculation of ratios will be extracted from the balance sheet, profit and loss account, and cash flow statement. Again, I repeat, the data, the figures for calculating the ratios will be extracted from balance sheet, profit and loss account, that is income statement, and cash flow statement. We are going to take into account the position of all the assets, liabilities, income, expenditures, cash at a particular time. This all will be taken from the, of course, accounting records or the financial statements. Now, when we talk about ratio analysis, it is a financial tool. And I told you it compares two data. It tries to establish the relationship between two or more variables. It tries to establish the relationship between two or more variables. And in this context, we take into account the financial statements of two or more than the items of financial state, two items from the financial statements or more than two items. Suppose the very easy example, how many marks you have scored, how many percentage you have scored in your exam. So here, what are the two aspects? The total marks, suppose it is 1000, and out of 1000, what is your score? If your score is 700, then this you cannot understand that what is 700. And if you have scored in the next year out of 3000, 2000, then if someone asks you to compare whether it is a good one compared to the previous, so you cannot answer because 3000 is something different variable and 1000 was different variable. So how can you give the answer to this? By converting your marks into percentage. So if you say 700 is the 70 percentage of 1000, and when you take 2000 out of 2000, the marks obtained out of 3000, in that the percentage you are going to calculate. And when you calculate, you will find it is less than 70%. So you can say that marks obtained 700 is more, it was more good, more better than the marks obtained 2000 out of 3000. So this, when you convert the financial data, the numbers, into percentage, then only the conclusion is what is better. Same way, we need to compare the figures for sale, purchase, expenses, dividend to be declared. So how to get the answer? Previous year's sale revenue is totally different from purchase. So if you want to give the return on the basis of previous year's sale and what is the result for this year's sale, the figures will be different. So we need to come to a common conclusion, and the common conclusion is the percentage. What was the sale percentage compared to your purchase or production or stock? What is the net profit if sales is this much? So it establishes a relationship between two variables, and when it establishes a relationship, the answer is expressed in the form of ratio. When we try to find out the ratio from the financial statements, the answer is known as financial ratio. Am I clear till this? Now we are coming up with the types of ratios. So there are various types of ratios if you want to find the short-term profit, long-term profit, what is the position of the shareholders, and so on. So these are the 6 types of ratios that mostly we need to study. Profitability ratios, in this the common variable is your profits. Liquidity ratio, here we try to find out the liquidity position, and liquidity position is based on your current assets and current liabilities. Next we have leverage ratios. The leverage ratios talks about the profitability. Coverage ratios, how much interest and all you pay. Efficiency ratios, they're also known as activity ratios. Compare your stock to stock turnover, and then valuation, the company's valuation. So let's start with the first one, that is profitability ratios. So this is a data given here. We will not go deep into this. This is a hypothetical firm ABC, and they have given a data from 2016 to 2020. So you can see here assets and liabilities are given. So of course it is a balance sheet. The liabilities consists of fixed liabilities are share capital, reserve and surplus. If you go with borrowings, then equity is net worth is the owner's share. Then we have borrowings in the form of debentures. Then we have short-term bank borrowings, and then the total borrowings. Then we have fixed assets. The first one is fixed assets less depreciation. Next we have current assets. Current assets in the form of raw material, work in progress, finished goods, which in total consist of your inventories. Then we have debtors. Then we have cash and bank balance and other current assets. Then we have a total of all the current assets. Same way we have a total of current liabilities, that is of creditors, provisions and all. So this is your total assets. What is the market price per share? That is also given. Now next it is income statement. Income statement is your income. You can see the position of your sales, raw material, direct labor, depreciation, and other expenditures. So the last one we will get your profit before taxes, profit, then you pay the tax and you will get profit after taxes. On the balance profit, we pay dividend, and from profit, once dividend is paid, the balance is your retained earnings. So on the basis of this hypothetical data, the calculations will be made. So we start with the first one, that is profitability.
Mama,
Yes?
the table above is given numbers or I want the table above is given numbers or calculated.
The
Or
figures
you
are
can see
calculated.
the
The figures are
and
calculated, but this is only a hypothetical data. But of course, the figures are calculated one.
Okay,
When
thank
we
you.
say we have minus this, the answer is actually what we have deducted or what we have subtracted. Okay? The numbers are not
Okay, thank you.
hypothetical, it is a calculated one. So when we talk about profitability ratios, we have the first one, it is gross profit margin. On the basis of profitability ratio, there are two profits, gross profit and net profit. Gross profit means the profit earned during a year by the firm. And this ratio includes mostly the what the firm spends on raw materials purchased, and then we compare it with sales revenue. So there is a term used, COGS. COGS means cost of goods sold. So gross profit is defined as the difference between the sales revenue, the amount you get from sales, and the cost of goods sold. So sales minus COGS. Sales minus COGS is your gross profit. And then you divide it by sales revenue. Next, we have net profit. So in place of net profit, gross profit margin, we are going to take net profit margin. So net profit margin is profit after taxes. In gross profit, we do not deduct tax. So in net profit, it is profit after taxes, or what we say net profit, and then it is divided by sales revenue. Next, we have net operating profit margin. Net operating profit margin is first operating profit, net operating profit after taxes. NOPAT is net operating profit after taxes. It can be EBIT 1 minus tax rate also. EBIT is earnings before interest and tax, divided by sales revenue, and then we have its margin. Its margin is earning before interest, tax, depreciation and amortization, divided by sales revenue. On the basis of these formulas, you are required to go with the calculations which they have given in the top. They have given you, and you apply these formulas in these, you will get the answer. There is one more for net profit. It is return on capital employed. Return on capital employed, in this we first go with earnings before interest and tax. What is the earnings with the shareholders? So the earnings, it is before interest and tax, divided by total debt. Debt is long-term borrowings, which we have seen as the loan from debentures, plus shareholders fund. Shareholders fund is equity share plus the reserve and surplus. Now the next one is earnings per share. Earnings per share, it is EPS. Earning per share, what the expected income from each share. So it is the profit after taxes that is taken into account, and it is divided by the number of the equity shares the company has. So it is profit after taxes divided by number of equity shares outstanding. Next, it is how much dividend we pay per share. So first we decide the total dividend that has to be paid, and the total dividend is divided by total number of equity shares, because dividend is paid only to the equity shareholders. Next, we have dividend payout ratio. It is total dividend divided by profit after taxes. Dividend yield, how much dividend is yielded? So it is on the basis of market price. Dividend yield is always on the basis of market price. So it is dividend per share divided by market price per share. Coming to the next one, liquidity ratios. Liquidity ratios are related to your short-term asset and liabilities. Short-term asset and liabilities means your current assets and current liabilities. Current assets are those assets which are to be realized within a period of 1 year. And current liabilities are those liabilities which are to be paid within a period of 1 year. So 1 year is the factor, 365 days. All those items which are realized or payable within a period of 1 year are termed as current assets and current liabilities. Current assets mostly include cash balance, bank balance. Yes, Ravi? Yes, Ravi, tell what you want to say.
I've got a question, ma'am.
Yeah, please.
The current ratio, is it calculated and at the end of the year, or is calculated when exactly? Because you're saying that the current asset over current liabilities, we are only considering an asset that are going to be acquired 1 year and
I understood. 1
liabilities
year.
that are going to be, yeah. So it's calculated at the end of the year.
No, it is not calculated exactly at the end of the year. It can be calculated at any time when you feel so. But
All
these
right.
ratios are mostly calculated on what is the base of their information, what is the source of their information. Their source of information is, of course, the financial statements, the balance sheet, profit and loss account, and income statement. And these statements are prepared periodically. It can be quarterly, it can be half yearly, and it can be yearly also. When it needs to be published and it is put forward before the public and the concerned authorities, it is yearly. But for the analysis purpose, that if I want to analyze that what is the performance, there are many companies which declares quarterly financial statements also. Always, to attract the investors, they say what is their quarterly profit, what is their half yearly profit. Mostly the banks give their data related to quarterly, half yearly. So it depends on the organization what they want to do, but the base of getting the information is your financial statements, either your profit and loss account, that is income statement, or balance sheet. So whenever you want to prepare this ratios, you want to analyze these ratios, you need to first prepare the financial statements. Then only you can go with the rest ratios.
All right. Thank you. So another last question is that
Yeah. You can have any
does
number of
all right.
questions. No need to be last.
Okay. Thank you. So does the current ratio show the performance, the current financial position or performance of a company? Like,
Yes.
what is it used for?
Yes, I will just start. I have not started current ratio. I was just explaining what is liquidity ratio. And in this liquidity ratio, the first ratio is current ratio. So current ratio, when I say liquidity ratio, it is all about your current assets and current liabilities. Now, when we talk about current assets and current liabilities, in current assets, we mostly try to analyze the cash position, the bank position, the debtors position. there is a format available for the contents of current asset and current liabilities. You cannot say that this is, oh, my debtors will be for 2 years, so it is not current. No, debtors are always deemed to be current assets because we suppose that the debtors are going to pay you back within a period of 1 year. Hardly you are going to allow them a credit period for 2 months, 3 months, not more than that. Okay. So when we talk about ratio, current ratio compares, it tries to establish a relationship between the current assets and current liabilities. In the current ratio, there is one very important term which comes, that is working capital. Working capital is the capital which we require to manage our day-to-day expenditures. We need some cash for conveyance, for paying office stationery, for printing, for paying the refreshment expenses of the employees. So this all expenditures are paid out from working capital. We never take loan for making a payment of 10 rupees. This has to be managed within the cash that we have. So when we talk about current assets and current liabilities, this is managed with working capital. So there is a formula for working capital. The formula is current assets minus current liabilities. So when I say it is current assets minus current liabilities, your current assets always has to be more compared to your current liabilities. In that case only you will be able to survive in the market. Otherwise, we are going to use the current assets for making the payment of current liabilities, short-term liabilities. And if you fall short in current assets, that means you don't have liquidity. Liquidity position is very bad. You don't have cash. You don't have bank balance. And when you don't have cash, you don't have bank balance, you are not able to make your daily payments. You are not able to pay the short-term loans. You are not able to pay the interest. You are not able to make payment to the creditors. And if this continues, it is a very bad remark on the company's financial health, and slowly, the credibility, the goodwill of the company starts deteriorating. So current ratio establishes a relationship between current assets and current liabilities, where we try to find out the proportion of current assets compared to our current liabilities. It is said that current assets should be the double of your current liabilities, because in current assets we have inventory also, and inventory cannot be realized into cash unless and until it is sold. What is actually realizable when you need cash? It is your short-term investment, it is your bank, it is your cash. So other than these three, you don't have anything which can give you ready cash. So we always say that the composition of current assets has to be more compared to the current liabilities. And your current ratio establishes a relationship between the composition to know the proportion of current assets in the business compared to your current liabilities. Am I clear with this?
Very. Thank you so much. Well explained.
Yes, ma.
Okay. Now coming to the next one. See, you can see here a current, I'm just highlighting. They are saying that the current ratio should be of 2:1. Why? There is no hard and fast rule. Even if you go with 1:1, then in that case, you have to be very vigilant related to the combination of your current asset. You should not have current assets more with receivables. It should be more with cash, bank, and marketable securities. If it is like this, you can manage very efficiently with 1:1 also. But as it is a business and fluctuations are there, so we say that we should have a double of current assets compared to current liabilities. The next part of this is quick ratio. Quick ratio is also known as asset ratio, and I told you that from current assets we cannot realize cash from inventory. Inventory is stock. Inventory gives you cash only when the inventory is sold in the market. And even if inventory is sold at credit, then again you have to wait for another few months or days. So in order to find out what is quick ratio, it is the filtration part of your current ratio. Current ratio gives you the idea of 2:1, the content of the combination of current assets and current liabilities in the financial structure. Quick ratio gives you the idea of actual position of cash, bank, and other short-term investments related with your current liabilities. So it is when we start with finding the relationship, finding the liquidity position of the company, we are narrowing the concept. So quick ratio is, I told you, we can have 1:1 also. So if you minus inventory from current assets, you can have 1:1 as your quick ratio. The next one is your, again going into more filtration process, it is your cash ratio. Cash ratio is nothing, it is only cash balance and bank balance. From your total current assets, cash and bank balance and short-term investment, we take all other debtors, provisions, inventory, all are subtracted from current assets and divided by current liabilities. So cash ratio, it only gives you to take cash, bank, and short-term investment. This is the actual liquidity position of your firm. Next comes net working capital ratio. Now, what is working capital ratio? I have explained you what is working capital. Working capital is current assets minus current liabilities. So if you want to understand what is net working capital ratio, it is net working capital divided by net assets. Now, what is net working capital? Net working capital is current assets minus current liabilities. Here they have missed the information, but we know what it is. It is the difference between, you can see which I am highlighting, it is the difference between current assets and current liabilities. When you get current assets and current liabilities, it is your net working capital. And this current assets minus current liabilities has to be divided by net assets. Am I clear? Tell me just if you have any doubt till this. Okay. Now I am taking the next one. It is leverage ratio. Leverage ratio means to find out the proportion of debt and equity which has been used in the firm. Now here are two terms which are used in leverage ratio. One is debt and one is equity. The combination of debt and equity is known as capital structure. Now equity means the owner's fund, the shareholders' fund. Equity means equity shares plus reserve and surplus. Whatever the owner has in the organization, it is all the reserves and the share that the organization has. What is debt? Debt is outside fund. Equity is owner's fund and debt is borrowed fund. In equity, if you have raised funds through equity, it is not necessary that we have to pay profit, interest, dividend. Dividend is paid only out of profit, and even if there is a profit, the company, the board of directors may not declare dividend because they need that money for some other use. So there is no compulsion in the declaration of dividend, but if you declare dividend, that dividend has to be paid out of profit. Now, the question is of debt. Debt is simple a loan taken from market, from financial institutions, and even it can be from the public. So when you issue debentures, when you issue bonds, when you take loans from financial institutions, banks, etc., irrespective of your profit and loss in the organization, you are required to pay interest. And this is a mandate. If you're not complying with the payment of interest every year, then the financiers can take you, even they can sue you to the court. You can be penalized, fined for this. So this is something which is statutory obligation for the payment of interest. Even if there is a loss, continuous loss in the organization, this payment of interest is an additional burden in the company's financial structure, because already there is a loss, and again you have to pay a huge amount in the form of interest, and this amount is paid out of additional borrowings. At present, with the present borrowings, if you're not able to pay the interest, you are in loss, then you can imagine with additional borrowings you will be more into trouble, you will be more into loss. But in order to minimize the risk of non-payment of interest, we again go for more and more borrowings. So what is the proportion of debt and equity? If more and more debt is there in the business, it is a financial risk to the organization, because if you're not able to pay, your business can be closed. So we try to find the proportion of debt and equity which is used in the business for business operations. So debt funds, they are available by the lenders, and then they are compensated with interest. So this is important. Interest is very much required to be paid on debt. But again, at the same time, though more and more debt gives rise to financial risk, but at the same time, what happens? The equity shareholders, they are the real owners of the company. So if you want to raise more funds and you want to raise it through more equity shares, it means that you are increasing the ownership of the company, and the existing shareholders, they are not ready to dilute their shareholding with others. They don't want to distribute the profit with others. So instead of raising the funds more with equity share, they prefer to raise it in the form of borrowed fund. And the process through which they do not want to raise funds through equity just because they want to enjoy more profit, more ownership in the firm, this process is known as trading on equity, and this is what actually is known as financial leverage. Financial leverage is use of more and more debt in the business. So in this, we try to find out first the debt equity ratio. And debt equity, it is very easy. Debt, you are going to take all the long term interest bearing funds in which you need to pay interest. Oh, sorry. And when you talk about equity, you are going to take the shareholders form, which is in the form of equity. So first one is debt equity ratio. Am I clear with the concept of leverage? Okay.
Yes, ma'am.
Manuel, today you don't have any doubt? How is it so?
No, no, no. I was just agreeing to what you were saying a few minutes
So
ago.
that
Thank you.
what I am saying, today you are not having any doubt. I don't like this. I need some doubt from your end.
No, no, no. There's no doubt. Thank you. It's clear.
Oh, okay. So coming to the next one, if it is clear. Now it is debt ratio. Debt ratio is how much debt is in the firm. So you see, it is long-term debt, long-term interest-bearing debt divided by long-term interest-bearing debt plus shareholders fund, that is equity. Debt ratio is The total debt ratio means finding out what is the ratio of debt in the business compared to the total capital in the business. The total capital comes from equity plus debt. This everyone agrees. 100% finance is debt plus equity. This everyone agrees. When you add debt and equity, you will get the total capital of the company. Am I okay?
Yes.
So now from this total capital, if you want to know what is the percentage of debt in the total capital, that is debt ratio. So debt divided by total capital, and total capital is debt plus equity. And if they want to know the equity ratio, then it will be equity divided by debt and equity capital. So the same thing they are saying here. If it is debt ratio, then debt is long-term debt, long-term interest-bearing debt divided by long-term interest-bearing debt and equity. Next, we come to the coverage ratios. So we know what is debt and equity ratio. Debt and equity, it tries to study the proportion of debt and equity in the total capital structure of the firm. There is one more ratio which is known as coverage ratio, and it tries to find out the adequacy or the profit to pay the interest. We have debt. Are we in the position to pay the interest on debt? This is what we call as coverage ratio. Am I clear? So interest coverage ratio means are our profits enough to pay the interest, and this interest is calculated from the profits that we have to pay. So interest coverage ratio means EBIT. EBIT is what is your earnings before interest and tax, because interest is not paid. So it is before interest and tax divided by the interest amount that needs to be paid. Am I clear till this?
Yes, ma'am.
Okay. So I'm taking a break for 5 minutes, okay?
Yes,
Okay,
ma'am.
Lima.
Okay.
Just 5 minutes, I will be back.
Madam, time for prayer in Nigeria.
Okay, so I hope everyone is there.
Yeah.
Okay.
Yes, no.
So I'm coming back to efficiency or activity ratio. So when we start with efficiency or activity ratio, in this we try to compare that how efficiently we are using the assets of the firm or business. They are also known as turnover ratios, where we try to find out the comparison of debtors, the inventory, fixed assets with the sales or turnover of the firm. So we need to find out the assets are used to the optimum in the firm or not. So in this, again we take into account COGS of the firm, cost of goods sold, which is also known as sales. So the first one in this, it is inventory turnover ratio. Inventory turnover ratio means that we take into account the opening and closing balances of the inventory, and then we try to find out against the sales what is the average inventory that we are maintaining. We try to find out, are we doing justice in inventory or we are just blocking the funds in the inventory. So the inventory turnover ratio, the formula is cost of goods sold or sales divided by average inventory. Average inventory is opening and closing inventories sum total, and if one information is not available, then whatever opening or closing inventory they have provided, the same has to be taken. So we need to understand against our sales, inventory is moving at a fast speed or slow. A low inventory turnover ratio means that our sales are very slow, or indirectly we can put a remark that the demand of the goods are not appropriate in the market. So we need to find measures to increase the sales. This is all the bifurcation of inventory ratio. Next, we will find debt turnover ratio. Debtor turnover ratio, debtor arises out of credit sales. So in credit sales, and when we compare it with average debtors, again we try to compare whether the firm is efficient with a lower debtor turnover ratio or it rotates its debtors more frequently. So we need to find out, we are having more debtors compared to our sales or the debtors are less. And if you want to know what is the period in which we are getting back the amount from the debtors, the average period, then what we do, we take average debtors, just the opposite of debtor turnover ratio, average debtors divided by credit sales multiplied by 365. In this way, we will be knowing the average collection of debtors in a particular sale. The second is related to, again, creditors. If you want to know the creditors turnover ratio, at what interval we make the payments to the creditors. So creditors also arise out of credit purchases. So the formula goes credit sales divided by average creditors. Next, it is valuation ratios. Investment ratio or valuation ratio, it is the earning ratio. How we find the earning ratio, that is price to earning ratio. Price to earning ratio, it relates the company's current market equity shares with earning share. What is your earning per share, EPS, and what is the market price per share? So the market price of equity share divided by earning per share. And if you want to know the book value ratio, then it will be market value per equity share divided by book value per equity share. If you want to know the enterprise value, the value of the company, then we try to take the earnings before interest, tax, depreciation, and amortization, and then enterprise value is divided by EBITDA. So this is all, and this all they have calculated. You just go with them. All explanation related to this with the hypothetical data is given. Try to solve it because this is full a solved example. Okay, so all that ratios that we have studied one by one, they have given the explanation with the example, hypothetical income statement and balance sheet that we have seen in the starting. So just do it. Okay. Now we are coming to the last one, and the last one talks about trend analysis, comparative common size statement. In this, we are going to start first with comparative statement. Comparative statement, it means that we take the at least 2 years balance sheet and then we compare it. The comparison is like this. There is a format. The two data, first you just understand this all information will be given the balance sheet. You will be given the data for 2 consecutive years for which the comparison has to take place. So you see here on the screen, you can see the first column, it is particulars. The second column is previous year and the next column is current year. Again, I repeat, the first column is previous year and the second column is current year. The third column is change and the fourth column is percentage change. Okay. So the first column, that is particulars, the second column, that is previous year, and the third column, current year. This all three will be given to you in the question. It will be provided the information. You will start with change and percentage change calculation. Now, previous year minus current year minus previous year. Always remember the first should be current year. Current year minus previous year is your change. So in the first case, it is you have to copy the balance sheet same way which will be given to you. So we are taking first the liabilities. If you remember, in the liabilities we had equity capital. So equity capital in both the years are same. There is no change. So in the change column, it is 0. And when it is change is 0, anything multiplied or percentage divide by 0 will be giving you the 0 answer. So the percentage change is also 0. Am I clear? Now take reserve and surplus. Reserve and surplus previous year is 1245 and current year is 1392. So when you subtract current from previous, what you get? A change. Your reserve and surplus has increased with 147 crores. So now you try to find out percentage change. Percentage change is calculated on the basis of the proportionate formula. You just compare this 147 with 1392 and multiply it with 100, you will get the answer. Just check, are you getting the answer? Did you get the answer? I'm just waiting for your answer. Yes. So what you did? 147 has increased from 1245. So 147.67 multiplied by 100 divided by 1245. 147 has increased from 1245. So 147.67 multiplied by 100 divided by 1245. So this is your answer. So whenever we want to know how to calculate the change in the percentage, so the percentage change is always calculated compared with the previous year. So you can see there is a change of only 147.67 crores, and then we compare this with the previous year's amount. The previous year's amount is 1245 crores. So when we see 1245, then we can easily see that there is a percentage change of only 11.86 percentage. Am I clear? Coming to the next one. All others you can calculate this way. Debentures, you see 10% debentures, 1129 and then 1550. So 1129 and 1550, the change is of 421.51. So this 421.51 multiplied by 100 divided by 1129. You will get the answer. Am I clear? I hope it is
Yes,
clear
ma'am,
with all.
that's clear.
Okay.
Yeah,
Now
yeah, yeah.
we are coming to the second one. The second one is common size analysis. Common size analysis, where we take into account, you see the format. The format is equity capital 356 and reserve and surplus, it is 1245 and 1392. Now in 20 and 21 we are going to make the analysis. So what it says that equity capital in the year 2020 is 356 crores, which is 71.15% of the total liabilities. So in common size, we take into account the total liabilities, and out of total liabilities, what is the content, what is the proportion of your equity capital? Am I clear? So here we take into account the total capital, and from there we do the calculations. Same way, when we go with the assets, we will take into account all the total of current assets, fixed assets, and all. The third part, that is the trend analysis. In trend analysis, we try to find out the trend. Trend means whether there is an increase or whether there is a decrease. So in trend analysis, you see this is an example given. You just see they have given the information related to sales, earnings, interest, profit after tax, liabilities, and so on. So now what we do, we try to find out one base year. What is the base year? Suppose from these, you take the base year as 18. And then we try to find the base year will be 100 because this is the base year. So if you take the base year and then from the base year, we try to calculate each year's progress. Am I clear? Suppose this is 2016. 2016 is your base year. So 2016, each and every item we find that it is of 100%. Whatever is the base year, that is 100. So you can see 2016 is base year, so it is 100. Now, what we do, we take the figure of sales of 2017. When we take the figure of sales of 2017, in the question, the sales for 2017 was 1957 lakhs. Here it is given 1957 lakhs. And this 100, its figure is 1890. So now we compare 1890 as the previous year and 1957 as the current year. So if you multiply it, then you will see that you are getting the percentage of 104.5. So the sales value will be 1957 divided by 1980 multiplied by 100. So 100 is your base and 104.5 is your answer. It means 100 minus 100, you are left with only 4.5. So the sales has grown to 4.5%. Am I clear with this?
It is. Yes, ma'am, it's clear. It's clear.
It's clear? So each and every item where you will see, suppose this is 100, and if you go with the earnings before interest and tax, in 17 and 18, it is 98.8 and 97.1. So it means it has declined. Earnings have declined. And next, in 2019, it has grown by 26% and 38%. So this is what is trend analysis. Am I clear? So this all information is there in the question. From there, you can easily make it out. Just go with the question, go with the figures that is provided in the start of this common size statement. Then you can easily solve it. For ratio analysis, all this information is given as a hypothetical figure. Am I clear?
You are.
So that's all for the day from my side. We have covered all the topics. So now it's your turn to practice it. I have made you understand. So if you have given your, yes, please.
Hello, ma.
Yes, Khalid.
So, I just want to make a request. As earlier said, you said you're going to share some videos with us so that
I
we
will,
can go to.
yes, I will share it in the next class. We are left with another 2 classes now, so I will share those videos link in your WhatsApp chat box. Okay?
It's okay. Thank you.
Okay. No, assignment is not my part. Assignment, you have to submit it on the link. You have to upload your assignment on the link. If you require any help, you just write me. I have given you my mail ID. I will get you back.
Thank you, ma.
Okay. So those who have given your names in the chat box, they may leave. Others who have not, please write before leaving the meeting. Please mark your attendance and then leave. So thank you. So we don't have class for another 3-4 days. I think again ma'am is going to schedule it on Saturday or Sunday. Okay.
Thank you.
Thank you. Thank you, everyone.
Thank you, ma. Bye-bye. Bye-bye.
Bye-bye. Good night.
Mom.
Bye-bye.